you're looking at this divergence that's effectively occurring. Again, I think the easiest rule of economics at this point is it appears the boomers always win. And that's really kind of where things stand, is that we've got a very bifurcated economy in which those who currently do not have assets and are trying to obtain them are struggling in an environment in which the assets themselves are very expensive. And now we've added the additional wrinkle that financing those assets is becoming increasingly difficult as well.
Mike Green, Chief Strategist and Portfolio Manager at Simplify Asset Management. It is so great to welcome you back on the show, and great to see you as always, Mike. Thank you so much for taking the time.
Julia, it's a pleasure to be back. Thank you for having me.
Well, I think it's been just about probably over a year since we last had you. And so I'm so excited to have you on again and just to get an update of where we are. And let's start where we always start with our guests. And that is to get your big picture macro view, the framework in which you're looking at the world today. And one of the things about this show, as you know, Mike, is you can take all the time you need to set the table when it comes to that macro picture.
Sure. So, the somewhat unique perspective that I tend to come at the markets from is this dynamic that I've highlighted about the growth of passive strategies and the fact that the markets increasingly embed dynamics that are mechanical as compared to thought-based. Most of the theories that you'll read about how markets behave are as a function of trying to incorporate information, right? So active discretionary managers look at the world and formulate an opinion about the future cash flows associated with NVIDIA or Microsoft and construct a discounted cash flow model that is then used to buy those. That's one way of thinking about how markets work, and it's it's called the information flow components. Another way of thinking about markets is what's called a flow-based component. It's simply a function of buyers and sellers, many of whom operate for reasons that we can't fully appreciate. Right. And unfortunately, I think that second model is becoming the dominant one, with the primary flow pattern being one simply tied to U.S. employment, in which you're actually looking at people contributing to their 401ks, typically buying a market cap weighted index. And that becomes kind of an underlying current that you need to be thinking about in terms of how the market behavior information can differ very much from the macro information. On the market side, we're seeing markets that are increasingly narrow, in which a very few number of stocks are pushing things up in a fairly significant fashion. I actually just ran this earlier today. If you look at the NASDAQ, you're up, I believe, 7+% for the year. If you look at the S&P, you're up, I think it's currently, let me check that actually. I'm sorry, that was actually for the quarter. I'm sorry. On a year-to-date basis, let me just pull this up here. NASDAQ's up 16.5%. On the flip side of that, if I were to look at the median stock within the Russell 2000, for example, so this is looking at the equal weighted Russell 2000, it's down 6% for the year. This is very, very similar to the behavior that we saw last year, in which through 3/4 of the year, the Russell 2000 equal weight was flat to down with almost no break, right? And on the flip side of that, the large cap companies, particularly the large cap technology companies, are kind of pulling away. I think that's actually very indicative of what's happening in the economy. We just saw the University of Michigan Consumer Expectations and Consumer Sentiment Report come out today, in which the surprising commentary, or not particularly surprising actually, is that the middle segment, right? So they split into lower tier, middle tier, and upper tier. The middle tier, which has always kind of straddled the behavior of the upper income and the lower income, has now begun to diverge significantly and move rapidly towards that lower income. It's the same thing we're seeing in the market. It's a narrowing of success factors that makes it increasingly difficult for most stocks to perform well. And for that matter, many households, or most households, are now beginning to really struggle under the combination of reduced work opportunities, fewer job openings, lower negotiating power with their employers, while a limited few, and in particular those who are retired with access to any form of wealth, are suddenly benefiting from risk-free income associated with money market funds, et cetera, that they haven't seen for well over a decade, right? So you're looking at this divergence that's effectively occurring. Again, I think the easiest rule of economics at this point is it appears the boomers always win. And that's really kind of where things stand, is that we've got a very bifurcated economy in which those who currently do not have assets and are trying to obtain them are struggling in an environment in which the assets themselves are very expensive. And now we've added the additional wrinkle that financing those assets is becoming increasingly difficult as well.
All right, that's such a great way to frame it with this bifurcated economy. And so I want to explore like the demographic part of it a bit more, because what does that say about the health of the economy? If it sounds like the boomers are the ones who are really benefiting, what about, younger generations?
Well, I think, unfortunately, that becomes fairly self-evident, right? The boomers are benefiting, again, from that increase in income. The yields that they're receiving off of many of their fixed income investments or the cash that they have in hand has suddenly turned into real money, right? So if you think about a retired household that managed to save its way to $1 million worth of liquid assets, if I go back 3 years ago, those assets would have been generating $1,800, something like that, 18 basis points out of a savings account, out of a money market account in an environment of zero interest rates. Suddenly that's become $50,000, $53,000 to be more precise, that they're generating, right? It's a huge bump in income. On the flip side of that, the other side of that equation is that the mortgage that you could have signed at 275 3 years ago is now going to run you 7. Right. And as a result, payments have surged alongside a relative shortage of housing that's kept prices relatively high in most markets. That, of course, plays through. I mean, again, we saw this in the sentiment indicators. Worst time to buy a house, basically, in history. Boomers don't need houses. Boomers want to sell houses eventually, right? Or increasingly more accurate, they're going to gift those houses to their children in the form of inheritance, where that long-term mortgage effectively becomes almost a generational asset. That contributes, I think, to feelings of nihilism and frustration amongst the younger generation, where they're somewhat candidly saying, look, there's no way for me to save my way to a house at this point. I'm either born into a family that can afford to help me to get that house, or they can offer me that house in the form of inheritance, or I'm not, right? And if the answer is I'm not, then you make all sorts of different life choices, right? You increasingly turn to short-term, get-rich-quick schemes that are designed to try to break away, because the downside is you're going to end up living with your parents anyway, right? So if you're going to live with your parents, doesn't really matter, right? I might as well try to break free with the motto for the lottery, right? Dream a little dream sort of framework. And I just think it's really caustic in our society right now. I think we see this in a lot of behavior. Obviously, I actually just wrote about the GameStop type experience, this second wave. And there's a sadness to it this time, I would argue, where people know that this is not actually going to break anything, that this is almost, like trying to tear a hole in the matrix and expose it for, the nonsense that it is. But at the end of the day, you've got a guy who showed up drunk and high to his podcast to have 1 million people watch him, lose $200 million, right? Just a really, really strange experience if you think about it.
Yeah. And also just I guess there's so much just this theme of bifurcation.
Yep.
Yeah. And so when folks talk about the economy, you'll hear folks are saying the economy is resilient. It's great. And then you'll get a totally different perception of the economy too. It's not so great. I guess it kind of depends who you ask. I want to kind of just, what is your assessment of the health of the economy?
Well, again, I think it depends on your perspective, right? So the state of California actually just had something very interesting happen. Part of the reason why we saw unemployment claims surge was because of a dramatic hike in minimum wage that led to fast food workers losing their jobs, right? We've not seen a hike in unemployment claims, despite the fact that Google and others have been laying people off, right? One of the reasons for that is because the nature of unemployment benefits and the nature of unemployment itself has changed so radically in the aftermath of the pandemic. One, people were exposed to far greater than traditional unemployment benefits in the pandemic, where they would regularly receive 2 or 3 times what they normally would have received under those conditions. Now they look at applying for unemployment. Let's say you're a Google engineer making $200,000 a year, which in Silicon Valley, as painful as it is to admit that, that's largely middle class, right? At best, you might even be struggling under that type of framework. That individual filing for unemployment claims, the maximum benefit that they can receive in the state of California is about $13,000 for an entire year, right? That's not going to do anything for them. And so what you're actually seeing is those who are endowed with the resources to turn around and do something like drive for Uber are choosing to drive for Uber. We're seeing this in the availability of Uber drivers, the premiums associated with Uber drivers, et cetera. So there's become a bifurcated track where if you actually have a car that is new enough and nice enough to qualify for driving for Uber, you're better off driving for Uber as compared to filing for unemployment claims. The lower end fast food workers that are now losing their jobs, they're going through the traditional route, right? Because they may not have a car, they may take public transportation to their work, they may, probably don't have a nice enough car to qualify for Uber in its traditional sense, and as a result, their options are much more limited, right? Because our authorities, right, the policymakers are looking at the latter, they're looking at the unemployment claims and the reported levels of unemployment as compared to the pseudo-employment of driving for Uber, for example, as an indicator. I think part of the problem is their perception is things are much better than they actually are. Whereas many at the lower end are suddenly saying, hey, wait a second, I was a Google engineer, now I'm driving for Uber. What do I do next? And that's kind of an extreme example, but I think it's a pretty realistic one for much of what we're seeing.
I actually had not thought of that, of like, if you kind of weigh it, okay, I can get 13,000 max in unemployment benefits, or I can make more doing that, driving Uber. In the meantime, especially if you, like you said, have a nice enough car and can get I didn't think about that, but when you look at the employment numbers and the data, like kind of look under the hood, I suppose you're probably seeing more of those kind of side gig, kind of gig economy type.
100%. This is exactly what you're seeing. You're seeing a reduction in hours. You're seeing a dramatic increase in part-time work. It is, all of these things are indications that effectively the gig economy, and to be clear, right, this is a sign of robustness within the economy that actually has the flexibility to adopt those workers and to allow those workers to work within the private sector. The problem is that we lose that signal unless you know what you're looking for.
It's so interesting. All right, going back to this theme of bifurcation, which I think is a great theme for the show, the markets and how narrow the markets have been, and the few that have really been kind of pushing the returns. We know the names. You do so much work in the impact of passive investing and the distortions that can have. Can we explore that a bit further? Maybe you can frame it up for folks who aren't as familiar with your work in this space, because that seems to be like a growing concern and risk out there, is just the impact of passive. And I know it's been talked about for a while, but maybe it's getting increasingly more so a risk.
Yeah, I think so. I think there's a couple of interesting things that are ultimately going on as we think about the growth of passive type strategies, right? So just to quickly define, when I think of passive strategies, what I'm really referring to are market cap weighted indices. The S&P 500 indices would be a good example of something that is a close proxy for that. A better example would be something like the Vanguard Total Market Index. BlackRock has an equivalent. Both are sponsored by what's called the CRSP, the Center for Research on Security Prices, which has a broad index that encapsulates all 3,600 publicly traded stocks in U.S. public markets. I don't think of passive, very quickly, as things like I'm putting my money into a technology fund that is run without the assistance of a human being. It's purely rules-based. So I just want to distinguish between those two. One is passive, quote unquote, and the second is systematic. I'm going to add a second layer of definition that's actually going to tell you there is no such thing as a passive investor. And the reason why I say that is that the actual definition of a passive investor is one who always holds every security. Right. So this is from Bill Sharp's The Arithmetic of Active Management, which is kind of the Bible foundational paper of how we mostly think about passive investing. It was written in 1991. footnote number 4 in that paper, and footnotes become really important in these discussions, right, is an assumption that they never buy or sell, right? That they can't impact the market through transactions. That's where the models ultimately break down, is that we know they are transacting. We know that when you have a job and you contribute to your 401k, your paycheck, a portion of that paycheck with employer matching, then flows into a market cap weighted index fund. Typically, it will be something like the Vanguard Total Market Fund through something like a target date retirement product. That means you're transacting, and suddenly it actually changes those passive players from passive to systematic, right? And so now we're back into this, everything's kind of systematic. That's where it starts to get really interesting, because what you end up discovering is that many of the behaviors that you would expect in markets don't actually match up with that. And in particular, there's an assumption that you're familiar, obviously, with the term the efficient market hypothesis, right? So the efficient market hypothesis is, again, built around this information flow dynamic. It effectively says all information that is available is contained within current market prices. I may have insights that NVIDIA is going to beat, right? Now, what's my natural reaction to NVIDIA beating? I buy NVIDIA shares. That pushes the price of NVIDIA up, and therefore the price of NVIDIA now reflects that information, okay? The assumptions under the efficient market hypothesis are that those flows that I just described, that buying and selling activity, has a remarkably small impact. And you would also expect it to have a much smaller impact on the largest companies relative to the smallest companies, right? Makes sense. We're talking about giant companies with trillions of dollars of market cap. Paradoxically, it actually turns out that the impact of those flows under the EMH model, the efficient market hypothesis model, the assumption is that a dollar into the stock market has barely any impact on the stock market itself because somebody else had to sell it to you, right? So a dollar in creates under EMH about a 1 penny increase of market capitalization because somebody had to sell you those shares, right? The most up-to-date estimates of this were done by an academic at Chicago, his name's Ralph Koijin, in concert with another academic, Xavier Gabe at Harvard. Their work on what's called the inelastic market hypothesis developed a mechanism for actually measuring that impact. And it turns out instead of a dollar causing 1 penny increase, it looks more like a dollar creates between $5 and $8 of increase, right? That means at minimum, the efficient market hypothesis is misspecified 500 to 1. As I like to joke, that's not even appropriate for government work, right? The second thing that ends up happening that's really important under those models is it turns out that the largest companies actually have the largest impact, right? And the reason why is there's two actual components to it. One is what falls under what's called the microstructure component, and the other one is what's called effectively the replacement framework. So under a microstructure framework, market-making activities, the actual Citadels and Susquehannas of the world that would be out there facilitating trading, entry, and exit, the profitability of their role is determined by a combination of the volume, the number of shares that are traded, and the bid-ask spread, how wide or what the profit margin is on each trade. When we look at the largest stocks, they will have market caps that are multiples of the volume differential in their shares. So just again, to put that in perspective, Microsoft at about $3 trillion in market capitalization will trade between 5 and 10 times as many shares as a company like Delta Airlines, which has a market capitalization of about $30 billion, right? So you're talking a 100x differential in market capitalization and only about a 10x differential in volume. The second thing that happens is because Microsoft is so large, the bid-ask spreads are very tight. And so it's just not very profitable trading Microsoft, right? Ironically, it turns out it's not very profitable. And so they put less capital relative to the market capitalization up. That means that trades into Microsoft actually cause Microsoft to move more on a market cap weighted basis than a company like Delta, right? So that's one of the components. The second is simply the replacement. And so many that are involved in passive investing are trying to imitate indices, will statistically sample the index to minimize the number of names that they have to buy. If I'm synthetically creating or statistically sampling the S&P 500, I can kind of ignore Delta Airlines because it's just not that big. It doesn't have that much impact on the market. And there's replacements for it. I could put in UAL or Southwest Airlines, and I'm going to get something that captures at least the macro factors associated with the airline industry without having the complications of having to buy 7 airlines, particularly smaller ones. But there is no substitute for Apple or Microsoft or NVIDIA. And as a result, I have to buy those, right? And so the combination of those two factors actually leads to the largest stocks being more impacted by these flows than the smallest stocks, which feels insane, but is actually supported empirically in the data. And so, again, part of what we're seeing is this narrowing is a function of these flows. Another one of those flows that causes this type of behavior are corporate share buybacks. So the largest, most profitable companies very actively buying back their own shares. In my opinion, they are absolutely influencing the price of their shares.
Yeah. Okay. And so another force at play here has to do probably with 401ks. You get those set up. A lot of those are flowing into these funds. Okay. So a couple of follow-ons. The dynamics of employment, how that factors into this, and then maybe even the demographics of like boomers starting to reach that retirement age. Maybe they're starting to draw down or withdraw or move maybe more into money markets. I want to just kind of hear about how you think about the impact of the employment part of it. Retirement, maybe folks losing their job, having to move to gig work where you're not having like your company, take X percent of your earnings and put it into a fund, matching and all of those dynamics as well. And then the retiring as well.
So yeah, let me pull up 2 charts. First, I want to show you. So this is on this issue of the bigger the company, the less elastic. So on the y-axis here, this is what's called the elasticity. This is how much the price does not change, right? So highly elastic, the price does not change very much for changes in supply and demand. Highly inelastic, i.e. zero elasticity, the price changes a lot for small changes in supply and demand. And instead of the smallest stocks being the ones that are affected, it's actually the largest stocks that are the most affected. This means that the narrowing of the market that we're actually seeing can be a byproduct of passive type flows, right? There's a second factor I think that's going on here is that people have increasingly kind of gotten the joke, or they've figured this out, and they themselves are then trying to put their money into narrower and narrower strategies, right? Well, I get it. Okay, it's all about AI. So I'm just going to buy NVIDIA, or I'm going to buy the 2x levered ETF of NVIDIA, right? Which is effectively doubling my buying power in those types of names. I think that's what's happening to the market right now. And I think that's an important component to it. So the second component is everything you're talking about in terms of 401ks, et cetera, are turning the market into a more and more automatic type system, right? It's effectively on autopilot. So this is actually looking at retirement options, things like target date funds. And the chart on the right is the one I want to hit for you. This was back in 2023. This is looking at 401ks. 80% of every dollar that's now going into a 401k is actually going in through a target date fund, right? So this is crazy when you actually think about what's actually happening, right? Everybody has become automated. The reason why is that the government grants these strategies effectively liability protection. They're what's called qualified default investment alternatives. And so when your employer offers you a series of retirement choices, if they offer you a fund that's managed by Jeff Gundlach or by Kathy Wood over at ARC, they actually expose themselves to liability, right? They're making a choice for you that's not government sanctioned. If they offer you a target date fund from Vanguard, they're offering you a product that's been sanctioned for 401ks, and it effectively prohibits you from being sued, right? Now, I often joke that Einstein was wrong. The most powerful force in the universe is not compound interest. It turns out that it's liability avoidance. And as a result, these products have grown explosively in the system, and an increasingly large fraction of retirement flows are actually going through these types of products. If I split that by age, it becomes even more extreme. So those who are later in their careers often will have had exposure to other types of investments earlier in their careers. They'll continue to plow money into them. Those who are younger default into these strategies and never leave, right? It's done for them. It literally becomes, I like to joke, it's a little bit like Web 2.0. If you're not doing any actual work in researching your investment options, and you're not actually doing any work in terms of selecting them, well, then it turns out you're the product, right? And that's really how the market is increasingly characterized. It is just assumed that there is a flow of, lemming-like behavior that is piling into these types of strategies.
And so earlier you said, I didn't know if you were going to share another chart. Earlier you said like a lot of folks they're kind of in on the joke right now. So I suppose it's like, okay, music's playing, you got to dance right now, be in on the joke. My question for you, Mike, is how do you think about how all of this ends? Have you thought about like the end game scenario or the worst case scenario? Like how does this kind of play out in your mind?
Well, unfortunately, I think what ends up happening is these mechanical strategies also have mechanical exits, and they have features to them that I think are really important. People tend not to think about. So it turns out that flow of capital into these types of strategies has an empirically proven relationship to increased valuations. There's actually another brand new academic paper, and this is one of the great ironies, right? John Maynard Keynes has a famous expression that, practical men who fancy themselves exempt are slaves to some defunct economist. We're all effectively slaves to Eugene Fama's efficient market hypothesis, this idea that we can participate without influencing, right? We can just follow along with the herd and behave, right? Because that's actually not true, we've created conditions under which people are increasingly going to be trapped into the market, right? Now, it's a very scary phrase, trapped, right? So I just want to be clear that as long as those flows remain net positive, you're actually participating in what's called a Ponzi scheme, right? So you are driving valuations higher as you participate. That's raising your perceived wealth. Those who are exiting now are being bought out by new entrants, right? That's a Ponzi characterization. There's a brand new paper out by Philippe van der Beek and JP Bouchard called Ponzi Funds that actually highlights the impact of these types of flows on the performance of funds. It makes a point of highlighting the behavior of ARK, the Cathie Wood vehicle, which was one of the most notable examples of this type of impact. What that means is when people try to get out of these strategies, that you're actually, if the paper is correct, and I think it is, that you'll actually see an accelerated reversal of all of these valuation gains. And so I would highlight for people that the flip side of the price that we see in the public markets, where extremely large companies like Apple, which is largely X growth, to be clear, right? They're trading at 30 plus times earnings. That's not a rational valuation for something if you were to take it private, for example, right? If you were to decide that you were going to buy something without growth, you can't pay 30 times earnings for it. You can maybe pay something like 10 times earnings for it in an environment like we have today with 5% interest rates. As a result, the next bid for Apple in the event that these funds start to sell could very well be down 70%. Right. And that's a big problem because it means that the retirement wealth in our economy is presumed to be much higher and much more liquid than it actually is.
It could be down 70%.
Yeah, I think that's right.
And also so the retirement wealth presumes to be larger than it is. I've often heard folks talk about we're already kind of facing a bit of a retirement crisis where people really aren't even prepared for retirement, or they don't have enough or as much as they actually need. Do you think that's also a risk out there too? This perception of retirement wealth and maybe what the reality is or could be?
Well, again, it's bifurcated, right? So the wealth in the stock market and things like 401ks have been available for give or take 40 years now for many of those who are in white collar jobs and have had good earning potential. And as a result, a combination of rising valuations, right? Imagine that some 401ks actually began in 1978, right? Just to orient people to that, the valuation in 1980 on the US stock market in 1981 was around 4 times earnings, right? It had been depressed to that level. Now, there were other factors in play. We had 15% interest rates, and you could argue that that was one of the primary drivers, and I think that's true. But, starting from 4 times earnings, we've now moved to, I think our current number is somewhere around 26 times earnings on the S&P 500, right? That means that 600% of the increase has strictly been a function of valuation, right? On an annual basis, that's a tiny amount, right? Like that 4 goes to 4.4 to 4.8, et cetera. It's a tiny increase in valuations as it occurs. But cumulatively, you have to look at that aggregate amount to understand that the assets that you now have, there's nothing that would prevent them from being marked down to 4 times earnings again, right? Now, that'd be far greater than the 70% markdown that I'm talking about. I don't actually think that that's going to happen, but you have to acknowledge that it is a risk, right? As you get later in your retirement, ironically, you start trying to transition your assets into fixed income, again, where you're getting great income today. And I think you're starting to see some signs of that in the market. The next question becomes, well, as you start to sell, to move into fixed income, do you actually start pushing those prices down? And again, this is that work of Van der Beek and Bouchard. What they show is the behavior that we saw in something like Cathie Wood's ARK fund, in which the gains were extraordinary and then reversed twice as fast, could very easily happen in the broader stock market.
Yeah, the selling. And like you said earlier, it was like the dollar. It's not just a penny in market cap. It's like $5 to $8 per dollar.
Yeah.
Fascinating. And then what that looks like it's not just the buying, the selling, what that looks like. So interesting. Okay.
Yeah, I'll see if I can pull up actually Bouchard's paper so you can actually see an illustration of this. Give me 1 second. So this is actually looking at that paper from Van der Beek. By the way, I said Van der Beek. James Van der Beek is the actor, of course, from Varsity Blues and various other 1990s hits. Maybe those are even early 2000s. I don't even know. But what they're measuring here is this is a quote unquote anonymized thematic ETF. It is ARK, of course, and you can see the price behavior that occurred. What they've done here in red is they've actually looked at this inelasticity factor that we were referring to, right? The impact of flows on price and measuring the impact of the inflows into the vehicle relative to the price. And you can see that it accounted for almost all of the gains, right? And as those flows reversed, it took it right back down, right? Now, by the time you get down here, it's a small enough fund that it's no longer having quite the same impact on many of its securities. But now do this for something like the Vanguard Total Market Index, right? Which is a $1.6 trillion fund that carries no cash. And if you redeem, it has to sell, right? Like it doesn't have a choice. There is no discretion associated with that. So those flows have a very direct impact. It actually turns out the larger the fund, the larger, the stronger the tie to an index type behavior, the more this actually matters, right? And so they give a series of examples of this type of stuff. So these would be examples, right, that they're actually showing here of exactly the same type of behavior across other vehicles, right? So these are ETFs that have been influenced by inflows. And again, this dynamic of how much of the return is actually explained by the flows. In most situations, we actually find that more than 100% of the returns are being generated from these flows. So this is just a warning. Like anytime you see something that's really hot and attracting capital, remember the George Soros aphorism, right? When I see a bubble, I rush in and buy. I contribute to its behavior, right? He was smart enough to figure out people are irrational. They will chase that performance. No shame. He's going to make his money one way or another if he participates alongside it. And once that reverses, the money starts coming out. Again, this is why it's called Ponzi funds. And it's the same behavior that we're seeing in our broader stock market indices.
So interesting. So we're just kind of effectively investing and living in one big bubble, I imagine.
I think, unfortunately, that's right. I mean, think about what's transpired over the last 150 years in the United States as the stock market has basically become the U.S. Pastime, right? An increasing fraction of us participate and save in it. When you think about the 1929 stock market and the mania associated with that, remember that less than 10% of the U.S. population actually held stocks at that point. So it was a very isolated and small bubble reflective of how tiny the financialization of the U.S. economy was. Today, it's well in excess of 50% of the population that owns stocks or mutual funds or ETFs and participates in the stock market and is influenced by this. For some people, it's the majority of their assets and their income, right? Those at the upper end of the wealth spectrum, that tends to be much more their profile, or they'll have their wealth contained within their own individual businesses. For those at the lower end, it tends to be much more the assets that you're accumulating are future claims on Social Security, et cetera. The irony is we're very focused on those claims, right? We're really worried about the deficit associated with those claims. Can we afford to continue to pay those? We're spending almost no time thinking about what are the implications of this type of behavior as an increasingly aging American society starts to withdraw from its retirement funds in the public stock markets, public bond markets.
That's interesting too. So you have this risk with the passive, and as folks start to retire, what that could mean. You did just mention the deficit and Social Security, and Social Security is on track to be bankrupt in X number of years. So do you think could we be facing two big risks in the coming years as it relates to this? Or?
Well, I think unfortunately that the two are both linked and both very real, right? So part of the reason that you really shouldn't worry about Social Security going bankrupt is that there are actually built-in shock absorbers created by the reforms of 1986, which is the last time we worried about Social Security going bankrupt. In the benefits will automatically be cut once we start running out of the revenues, and they're on target to be cut by about 40%. Right now, think about the cruelty associated with that. You're effectively saying to those who rely on Social Security income, we're going to cut your compensation by 40% because we don't have enough revenue. At the same time, as much as I would like to see my taxes cut, the reality is we're underfunding our own government's operations. You can disagree with how we spend the money. We can be frustrated by that. We can, think that, various boondoggles into green energy or anything else under a poorly named Inflation Reduction Act are bad uses of the government's money. But at the end of the day, to choose to underfund it means that we have to run deficits, right? We have to actually allow the debt to accumulate. And, you're talking about cutting the benefits to the lowest tier of society, even as we turn around and talk about increasing incomes to those at the higher end, right? That's a problem. It's a real issue that we have where we are incoherent in our policy.
Yeah. Okay, let me ask you this. This is such a fascinating episode. I'm loving learning from you and all the knowledge that you're sharing. I'm going to do more of a big picture. What for you is the biggest risk? Maybe it's something that's keeping you up at night or you're thinking about that's not being discussed quite enough.
To me, that's part of the reason why I spend so much time raising awareness about the dynamics of passive investing, because I do think, unfortunately, that we have shifted our retirement service or our retirement planning to a mechanical system that we presume we understand how it works, but it's really kind of a black box, right? Why does the stock market go up? Well, earnings, right? Earnings cause it to go up. That certainly contributes, but that's actually not a direct mechanism. People have to value those earnings. And if you're simply plowing your funds into a 401k through a target date fund, you don't have any idea what those earnings are. You've done no work associated with that, right? All you care about is the price, because that ultimately determines your wealth, right? An increasing fraction of the returns to the stock market now come through price as compared to dividends, which would have been a historical method of returning income. Dividends are largely meaningless on the S&P 500. The dividend yield on the S&P is about 1%, right? So you're actually not, it's almost going back to those dynamics we were talking about with the boomers before, where they were getting zero on their savings, right? If you're only getting a 1% yield off of your $1 million 401k portfolio, congratulations, you got $10,000 a year, right? That's not anywhere near enough to spend your way through retirement, particularly if you start talking about things like Social Security getting hit as well. Right. So what you need to do is you need to figure out, okay, I'm going to start selling stuff, or I'm going to start rotating away from the S&P 500 into things like bonds, right? Whether it's U.S. government debt, which would be the quote unquote risk-free component of it, or whether it's tied to U.S. corporate debt or various other forms of debt. Those are ways that you could increase your income dramatically. And I have to believe that people are going to start to do that. But now, ironically, if stock prices start to fall, the collateral and the value associated with the offset to the bonds starts to fall. And in many cases, you'll actually see the bonds themselves become riskier in that type of framework. So it's an integrated system that unfortunately is all being pushed in one direction right now.
Yeah, that's just the way things integrate. It's so fascinating. I should have used the word insolvency versus bankrupt, but on the Social Security side, do you think that gets resolved?
Well, I mean, this is the challenge, right? If we run large deficits in advance of that, it becomes harder to address that in a way that allows people to come out whole. There is a finite amount of resource that can be applied to the public sector, right? We all experience this in our day-to-day existences, right? I have to first cover my own living expenses. I can choose to reduce those living expenses. That introduces John Maynard Keynes' The Paradox of Thrift, where my savings suddenly become reduced income to you. You try to reduce your spending in response to that reduced income, and this economy cycles into what looks like a recession or a depression, right? This is that same underlying behavior when we start talking about the government. At some point, somebody has to give up something, right, in order to fund these things. And it can't just magically occur through the mechanisms of a stock market that are being pushed up by increased participation.
Yeah. Before I let you go, we actually didn't bring up the Fed in this conversation, but perhaps we should. It seems like maybe a rate cut is on the table. I would love to get your thoughts on inflation and maybe what inflation actually is. Let's do the Fed, interest rate policy. We can throw inflation in there as well. Just want to hear your thoughts there.
So, I fall into a camp. First of all, I think it's actually important, the observation you just made, right? Most people will come on to your show and start talking about the Fed immediately, right? Or start talking about modern monetary theory or everything else. What I want listeners to take away is that I've actually provided you with a plausible mechanism for why stock prices and valuations have risen without once mentioning the Federal Reserve, right? So that's actually kind of important if you stop and think about it. The second thing, though, that I would then highlight is remember the Federal Reserve has told us that they are data dependent, right? They react to these market signals. And again, part of what I'm trying to convey to you is that the market signals themselves are increasingly diverging from the fundamentals. There's no sign of the bifurcated economy except in the spread between large cap and small cap. And I can almost guarantee you that the Fed is not spending any time looking at the subcomponents of the S&P 500 to figure out if the equal weight is underperforming the market cap weighted S&P, for example, right? A lot of discussions around small cap, a lot of discussions around emerging stock markets, et cetera, with very little consideration for the mechanisms that actually causes the behavior to be driven this way, right? So I think it's part of what we're unfortunately seeing is that the Federal Reserve is likely to be quite late in its policy reaction because the markets themselves have become increasingly divorced from the fundamentals and are increasingly tied to what are traditionally lagging economic indicators like employment, right? Do people have jobs? Do those who are at the higher end of the spectrum and have 401ks, do they have jobs? That actually becomes increasingly important in this discussion as well. And so unfortunately, what it means is just like the markets have ceased becoming discounting mechanisms that try to incorporate forward information in an effective way, the policymakers are then being hamstrung by that, where they're not receiving the feedback that says, hey, things are weakening until it's likely too late.
That is fascinating. So do you think they're going to be late to cutting or, maybe I'll ask you like your assessment of the interest rate policy thus far. Are they right to remain unchanged at this moment? Just what are your thoughts there?
Well, again, I think this is this interesting bifurcation, right? So we are seeing within our economy a tremendous bifurcation. I hate using that word over and over again, but it is really what we're seeing, where companies that are cash rich are currently benefiting from the increase in interest rates. Apple's and Google's net income has risen significantly because of the return on the cash balances that they carry, right? They've been able to earn much higher returns associated with that. I'll give a really simple example. If I look at Apple's accelerated buybacks that they just announced, because Apple's valuation is so high, you can think about those buybacks as having a lower return than if they simply kept the money in cash and earned money market-like returns. Now go a step further and now think about what happens if the Fed tries to respond to the growing distress that we're seeing in commercial real estate, smaller businesses, companies that have borrowed significantly, so private equity type funds, et cetera. All of those are starting to see elevated levels of distress and an increased need to either file for bankruptcy and try to wipe the slate clean, or transact at much, much lower prices. We're seeing this in commercial real estate in particular, right? Those types of behaviors, once they've transpired, right, you can't change the arrow of time and go back. So once a company goes bankrupt, or once a person goes bankrupt and changes their credit rating, their access to credit becomes impaired, and they can no longer be a viable financial entity in our economy. Right? That's what causes these things to build on themselves. Just imagine, in your listener base, somewhere out there, somebody's filing for bankruptcy right now. They can't access credit tomorrow, right? Today they can, tomorrow they can't. So that's how these things tend to go. I look at it and I say, look, I don't actually care whether the Fed cuts interest rates by 25 basis points. I think it has a very marginal impact on most of the financial market components, particularly because we're already at a point in which credit spreads are so tight. Right, so we're near historic tights in credit spreads. So the Fed cutting interest rates by a very modest amount is really not going to change anything at this juncture.
Yeah. I have to say, Mike, it's been awesome having you back on. You heard me taking so many notes earlier. I learned so much in this conversation with you. I want to get you back on more often because you are absolutely brilliant. I love listening to you. I know the audience is going to enjoy this episode as well. Can I just give you the final few minutes to let folks know where they can learn more about your work at Simplify? I also know you have a Substack as well. Anything that you want to share, parting thoughts, something that you want to leave them to think about? The floor is yours.
If I'm thinking, so first of all, in terms of finding me, getting in touch with me, the easiest place to find me is my Twitter account is @ProfPlum99. I'm an active poster on Twitter. You mentioned my Substack. That is yesigiveafig.com. Somewhat of a joking reference to one of the funds that I run. And there I publish weekly on various macroeconomic thoughts, the type of stuff that we're discussing today. There's a lot of discussion around the bifurcation of the economy, et cetera. You can find a lot of that there. The Simplify website, Simplify is an ETF firm. We offer innovative ETFs that try to address some of the issues that I've highlighted. Our team there is absolutely fantastic. I encourage people to check out the Simplify website at www.simplify.us. In terms of the thought process, I just encourage people to actually think about this discussion and recognize that a lot of the metrics and a lot of the villains that are often brought to the story of, here's why the world is falling apart, right? It's money printing and the Fed, et cetera. I actually think, unfortunately, those are reactions to the situation that we've created. If you outsource the retirement system and you change it from an obligation of the government or businesses and you turn it into an irresponsible, and I mean that in the most positive sense, right? The market owes you nothing in terms of a retirement. It's not like a corporation that carries a liability or a government that carries a liability, right? If you outsource it to the market, the Federal Reserve really doesn't have a choice. You can't let retirement systems fail because it creates that cascade that we were referring to before. And I think, unfortunately, we're moving closer and closer to that point where simply our monetary system and our political system can't allow these things to fail. That creates its own host of issues, which a lot of other people, I think, spend a lot more time talking about. But I think that first step is the one that most people need to be much more aware of.
Mike Green, Chief Strategist and Portfolio Manager at Simplify Asset Management. Thank you for being so generous with your time, your ideas, your knowledge, your wisdom. I really appreciate you taking the time. Thanks again.
All right, my pleasure.